Okay, let's dive in. We're unpacking the latest results from Mahindra and Mahindra Financial Services Limited, MMFSL. They're a really big player in India's rural and semi-urban finance scene.
Absolutely. A key name.
Yeah, and we've got quite a bit to work with here. Official board meeting docs, auditor reports, investor presentations, and importantly, the earnings call transcript.
A good stack of sources.
Right. So our mission today for you listening is to cut through all the numbers, the jargon, and really get to the heart of MMFSL's performance, their strategy, where they might be heading.
Sort of a shortcut to understanding their Q1 for fiscal 26, the quarter ending June 30th, 2025.
Exactly. Think of it like that. We want to get a handle on how they're doing, especially with this idea of muted growth in some places, but maybe some interesting strategic moves happening underneath. Let's get started.
Sound good.
Okay, so kicking off with those top-line figures. Standalone net profit after tax, PAT, came in at 530 crores.
Which is about 3% growth year on year. Modest, but growth nonetheless.
Right. And consolidated PAT was actually a bit stronger, 529 crores, up 6% compared to last year.
Oh, yeah.
But where things look really quite strong was revenue. Total revenue from operations. Standalone hit 4,419 crores. That's a big jump, 19% year on year.
Wow, yeah, 19% significant.
And consolidated revenue also up nicely, 16% year on year, reaching almost 5,000 crores, or 4,990 crores to be exact.
So strong revenue momentum. What's fascinating here, though, is how these initial numbers sort of set a baseline. You see this strong revenue, decent profit growth for an NBFC of this size, operating where they do.
Yeah, in that unique rural dynamic.
Exactly. But then let's talk about disbursements,
Yeah,
because the picture there seems a bit different.
it does. So disbursements, the actual new loans going out the door were, well, flatter. Standalone disbursements were 12,808 crores, just 1% up year on year.
Just 1%, okay.
And consolidated was similar, over 13,623 crores, only up 2%. And, management themselves, in the earnings call, they called this muted or flattish for the quarter.
Right. They acknowledged it.
They did, but they were quick to add, don't read too much into one quarter for the whole year's performance.
Which is fair. Quarterly fluctuations happen, especially in their segment. But it raises that question, how do you get 16, 19% revenue growth with only 1-2% disbursement growth?
That's the key, isn't it? And it seems to point towards efficiency and the performance of their existing loan book.
Makes sense. Let's look at the assets under management then, the AUM.
Okay, so the AUM, or the gross loan book, that paints a healthier picture. Standalone AUM reached 1,022,008 crores. That's a solid 15% year-on-year growth.
Okay, 15%, that's more like it. So the overall book is still expanding at a good clip, even if new lending was slower this specific quarter.
Precisely. And that ties into their core profitability before provisions, the pre-provisioning operating profit, or PPOP. Standalone PPOP was strong, 1,353 crores, up 19% year-on-year.
Right, mirroring that standalone revenue growth.
Yeah. And consolidated PPOP was 1,379 crores, up 15% year-on-year.
So that PPOP growth, despite slower disbursements,
Right.
that really does signal good core operating efficiency, doesn't it? They're managing costs, generating income effectively from the assets they already have.
Absolutely. It suggests the underlying engine is running well. Let's dig a bit deeper into some of those financial health metrics.
Good idea. Margins, asset quality. That's where the story often lies.
Okay. Net interest income, NII, basically, the profit from lending. Standalone NII was 2,285 crores, again, strong growth, 18% year-on-year. And their net interest margin, the NM, for the quarter came in at 6.7%.
6.7%. How does that compare, and what's the outlook there?
Well, management sounded pretty confident. They actually said they believe NIMs have bottomed out at 6.5%, and they expect positive movement going forward. So they see margins potentially improving from here.
That's a positive signal, definitely. Bottoming out margins would be welcome news. Okay, what about the flip side? Credit costs and asset quality, always critical for lenders.
Right. So standalone credit costs were 660 crores. Now, that is a significant jump, 47% year-on-year. As a percentage of average total assets, that's 1.9%.
Oh, 47% increase in credit costs. That sounds like a red flag initially. How did the asset quality numbers look alongside that?
Well, that's where it gets interesting. Gross Stage 3 assets, or GS3, the loans showing more significant stress, were 3.8% standalone. That's only a tiny bit up from 3.7% in March, not a major spike. Consolidated was 8.3%.
Okay, so the actual stock of stress loans didn't jump massively.
No. And importantly, their combined gross stage 2 and gross stage 3 assets, so including the loans showing early signs of stress, stood at 9.7% standalone. That's still within their target of keeping it below 10%.
So if the GS3 stock didn't rise much, why the big 47% jump in credit costs? Management must have explained that.
They did, and it's quite nuanced. They said it was primarily driven by a deliberate increase in their provision coverage ratio, the PCR, specifically for those stage 3 assets.
Okay, so not necessarily more bad loans, but putting aside more money against the existing bad loans.
Exactly. The standalone PCR on stage 3 went from 51.4% a year ago up to 59.8% in June 2024. They're basically building a bigger buffer. Management framed it as wanting less intra-quarter volatility in asset quality.
Right. That makes sense. It's a more conservative approach.
Right.
Proactively strengthening the balance sheet rather than reacting to a sudden surge in defaults. It's actually quite prudent.
Yeah, it seems like a deliberate choice. Okay, moving on to capital and liquidity, always fundamental.
Absolutely, the bedrock.
Their capital adequacy ratio, CAR, looks healthy at 20.6% standalone. Tier 1 capital is 17.9%.
Solid numbers.
Well above regulatory minimums. And they flagged a strong liquidity buffer, too, over 10,100 crores.
Plenty of cash on hand.
But the big news here was the recent rights issue. They raised about 3,000 crores through that.
Yes, that completed recently.
Right. And that infusion boosted their equity capital and securities premium. It also meant the parent company, Mahindra and Mahindra Limited, slightly increased its stake to 52.49%. But crucially, it significantly improved their standalone debt-to-equity ratio down to 4.75 to 1.
4.75. That's a much more comfortable level of leverage.
Yeah, management described it as being very well capitalized now for future growth.
And connecting that to the bigger picture, those capital and liquidity figures are just vital for an NBFC. It's not just about surviving shocks, it's about having the firepower to grow, to fund expansion, especially with the market dynamics they face. That improved DE ratio gives them a lot more room to maneuver.
Absolutely. Which brings us nicely to, well, the business itself. Here's where it gets really interesting. Unpacking the strategic moves behind these numbers.
Yeah, but why behind the what?
So we know overall disbursements were flat, just 1% growth standalone, but underneath that, big differences. The absolute standout was tractors.
Oh, how did they do?
Tractor disbursements surged 21% year on year, standalone. Really strong. They said it led to market share gains.
Wow, 21% in tractors is huge.
Yep.
That must have helped offset weakness elsewhere.
It seems like it. Passenger vehicles were up just 2%. Pre-owned vehicles up 3%. Pretty modest.
Okay.
But then you had segments that actually shrank. Commercial vehicles and construction equipment, CV and CE, that was down 12%.
CV down 12%. Any reason given?
Yes. Management was quite clear. They said they are calibrating the CV business. They've actively chosen to stay away from certain fleet operators because the margins are just too thin, too much pressure from mainstream banks.
Strategic retreat for profitability. Makes sense. Focusing elsewhere.
Yeah, they said the focus remains on SEV, LCV, the smaller commercial vehicles, and buses where the pricing is better for them.
A deliberate choice then. What about the other declining segments?
SME, small and medium enterprises, that was down 19%, and three-wheelers were down 5%.
SME down 19%. That sounds quite sharp. Did they explain that one?
They did. They called it temporary and linked it directly to a rejig in their distribution and geography strategy. Basically, they restructured their sales management, moving from 4 zones to 2 national sales managers.
Okay, so internal restructuring impacting short-term disbursements. But what about the underlying SME book?
That's the interesting part. Despite the disbursement dip, the actual SME asset book grew 28% year on year, reaching over 6,500 crore.
So the portfolio is still growing strongly overall.
Yes, and a key detail here. Loan against property, LAP, now makes up 44% of those SME assets. That's up from 33% last year.
LAP generally seen as more secured lending.
Exactly. And asset quality in SME looks very strong. Stage 3 is only 1.4%. So even with the temporary disbursement blip, they seem confident. Management expects SME to become a very, very solid contributor.
Okay, so maybe a short-term dip for a longer-term strategic gain and potentially a de-risked portfolio with more LAP. That fits the pattern.
It does. And it also fits with their broader push for diversification beyond just vehicle finance. They explicitly called that a key strategic priority. The non-vehicle portfolio grew 30% year on year overall.
30% growth in non-vehicle. That's significant diversification in action. What areas are driving that?
Well, the leasing arm, Quicklease, they said, is gaining momentum, mostly B2B, but some measured B2C expansion too.
Okay, leasing.
Insurance is another one. They've got a corporate agency license now, and it's generating healthy fee income.
Fee income is always good for smoothing out lending cycles.
And here's a really interesting nugget on insurance. They highlighted a euro 46 crore dividend payout coming from their subsidiary, Mahindra Insurance Brokers Limited, MIBL.
A dividend from the subsidiary.
Yeah, and they said this should be a recurring thing because MIBL is consistently profitable and it's a capital-light business. Even after paying this dividend, MIBL apparently still has a cash surplus of 540 crores.
Wow, that's smart. Using the profitable capital-light subsidiary to send steady cash back up to the parent. That really helps MMFSL's overall financial profile.
Definitely seems strategic. And then there's Housing Finance Mahindra, Rural Housing Finance Limited, MRHFL.
How's that looking? It's been a focus area.
They described it as being on a turnaround path. It actually registered a, quote, bad positive in Q1, basically. Just broke even or slightly profitable.
Okay, so stemming the losses, what are they doing there?
They said they're making edits to the business model. That includes right-sizing the organization quite drastically, from 9,000 people down to 5,500.
Wow, that's a significant reduction.
Yeah, and they're adjusting ticket sizes, tweaking pricing, trying to get it in the right corridor. The message seemed to be, let's get the playbook in order first, before trying to really scale this business up significantly.
Sensible. Fix the model before hitting the accelerator. Okay, any updates on the digital and operational side? That's been a big theme for them.
Huge theme. They successfully migrated to a new cloud-based loan management system, LMS, in June. Apparently, almost all the loans disbursed in June went through this new system.
That's a major back-end overall. Must improve efficiency.
Presumably. They've also set up 2 fully operational centralized processing centers, streamlined the branch structure. They're using AI for early warnings on delinquencies, pushing self-service platforms for customers, a digital portal for insurance.
Sounds like a comprehensive tech upgrade.
It does. And this genuinely surprised me. They said their mobile app is now considered one of their biggest branches for bringing in customers and handling transactions.
The mobile app as a branch. That's quite a statement for a company with such deep physical roots in rural India.
Isn't it? It really shows the shift happening.
It really does. And, this raises a really important question. How do these digital leaps and these strategic shifts, like in CV and SME, how do they impact not just the quarter's numbers, but the fundamental agility, the future growth path of a company like this, especially one so embedded in India's, very diverse micro markets?
That's the million-dollar question, isn't it? How does this translate long-term? So let's talk outlook. What did management say about the road ahead?
Yeah, what's the feeling for the rest of the year?
Well, the overall tone was, look, Q1 was reasonable, stable, maybe muted on growth, but it's too early in the year to make a call on the whole of FY26.
Cautious, but not pessimistic.
Exactly. They said they remain optimistic and see the rest of the year positively. They specifically pointed to some tailwinds they expect will help.
Oh, like what?
Things like strong rural cash flows, helped by good distributed monsoons so far, record Kharif sowing levels, encouraging minimum support prices for crops, a generally favorable policy environment, and low inflation.
Okay, so a lot of positive macro indicators for their core customer base.
Seems so. And they also specifically mentioned the upcoming festival season. Because it's concentrated into 1 month this year, they expect that to give a significant boost to business.
Right. The festive season is always key for consumer sentiment and spending.
So putting it together, their medium-term goal or aspiration is still to achieve mid-teen growth, maybe around 15% in both disbursements and the overall loan book. They feel the company is primed to catch opportunities for growth.
Mid-teen growth. That's ambitious but achievable if those tailwinds materialize. What about profitability targets?
Yes, they have a very clear target. Reach 15% return on equity, ROE.
15% ROE. How do they plan to get there?
The plan is stepwise. First, aim for a 2.2% return on assets, ROA. They call that the first stop. And then leverage up from there to hit the 15% ROE.
Okay, so improve asset profitability first, then apply leverage. Makes sense.
And tying back to capital, they reiterated they feel very well capitalized with that 4.75 debt-to-equity ratio, and they have no current plans to raise more capital.
Good position to be in. Any mention of employee trends? I know we talked about the housing finance subsidiary downsizing.
Yeah, there was a slight decline in overall employee numbers mentioned in the reports, but they clarified it was largely due to a shift from on-roll to off-roll staff. The total headcount, including off-roll, remained relatively flat. Employee benefit expenses did go up 11% year-on-year, though.
Okay, so maybe wage inflation or changes in mix rather than just headcount reduction overall.
Yeah.
Got it. So if you were to sum it up for the listener,
Yeah.
what's the takeaway?
Well, how would you put it?
I'd say, in essence, you're looking at MFSL navigating in a bit of a mixed bag. Some short-term challenges like the muted disbursement growth, but they seem to have a very clear strategic compass. They're leveraging strengths in core areas like tractors, but also systematically diversifying like into insurance and LAP within SME, and really pushing hard on operational efficiency and digital. It feels like a classic case of balancing that immediate quarterly performance with a longer-term strategic vision.
Well said. A balancing act. And that brings us pretty much to the end of our deep dive into MFSL's Q1 FY26 results.
Yeah, covered a lot of ground.
We definitely have. We've seen a company that's, as you said, steady, strategic, quite optimistic despite that muted growth quarter. They're using those deep rural roots, but also embracing new tech, diversifying, trying to live up to that mantra of theirs, har ke paas, har ke sahat, close to India, with India. So here's maybe a final thought, something provocative for you to chew on after this discussion. Given MMFSL's really strong position in rural India and these very deliberate moves into digital, into broader financial services, how might that unique Bharat ke paas, Bharat ke saath mantra actually evolve? How could it help them capture the next wave of financial inclusion and growth, especially as India's rural economies themselves keep changing so dynamically?
That's a great question. How does the mantra adapt to the changing FedApp?
Something to think about. Anyway, thank you for joining us for this deep dive today.
Pleasure as always.
We really hope you feel more informed and ready to explore these insights further on your own.